Welcome to a new deep dive. Today, we're looking at something maybe a bit different, the core ideas of financial accounting. We're going to sort of distill these fundamental principles, go beyond just memorizing terms. Our goal here is to pull out the really important stuff, make these basic accounting ideas, well, accessible, and maybe even a little exciting, whether you're, prepping for a big meeting or just trying to get up to speed on the field, or maybe you're just curious. Think of it as like a shortcut to understanding how businesses actually track their money.
Absolutely. And what's really interesting is how these concepts, which can seem quite simple on the surface, really are the backbone of all financial reporting. They're not just about looking back. They help businesses, big and small, understand how they're doing right now and make pretty critical decisions for the future. Stay agile.
So what's the takeaway for you listening? Well, you'll leave with real clarity on things like debits and credits, depreciation, how assets kind of age financially, and why something called a trial balance is like a key checkup. Get ready to understand the language of business. Okay, let's get into it. All right, let's start at square one. Accounting. People call it the language of business. What does that actually mean in practice? Why is it so fundamental?
Well, basically, it's this systematic process. You identify financial events, then you record them, classify them, summarize them, and importantly, you interpret them. It's not just about crunching numbers. It's really about turning those numbers into a coherent story, a story about the business's health.
Okay, so it's more than just bookkeeping. What are the main goals? Why do businesses put all this effort in?
Yeah, good question. There are really 5 key objectives that make it essential. First, keeping a systematic record. Sounds basic, but it avoids chaos and errors. Second, figuring out profit or loss. That happens through the income statement, or sometimes called the P&L account, crucial for knowing if you're winning or losing. Third, understanding the financial position, what the company owns and owes. That's the balance sheet. It's a snapshot in time. Fourth, it really helps with internal decision-making. Future planning. You can't make good plans without good data, right?
Makes sense.
And fifth, compliance. Making sure you're following tax rules and other legal stuff keeps you out of trouble.
It's like, think about a little coffee shop, right? The owner tracks every bag of beans they buy, every coffee they sell, the rent. That tracking, whether it's in a notebook or fancy software, that is accounting. It's how they know if they need to maybe raise the price of a latte.
Exactly. It scales up, but the principle is the same.
Okay, so if accounting's the language, and those are the goals, what about the rules? The grammar, so to speak. These golden rules or principles that make sure everyone's speaking the same language.
Precisely. These principles ensure consistency and accuracy. They're not arbitrary. Some key ones are, first, the going concern concept.
Going concern?
Yeah, it's the assumption that the business will keep operating for the foreseeable future, not that it's about to liquidate tomorrow. This affects how we value things.
Yeah.
Then there's the accrual concept. This one's really important. You record income and expenses when they happen, not necessarily when cash changes hands.
Ah, okay. That can trip people up.
It can. We'll probably circle back to that. Then, consistency means you use the same accounting methods each year.
Why is that so important?
So you can compare results fairly, year over year, see trends.
Right. Apples to apples.
Exactly. Then, money measurement. Basically, you only record transactions you can put a monetary value on, like dollars, euros, whatever.
So things like team morale, though important, don't show up directly on the books.
Correct. Not directly. And finally, the matching concept. This means you match expenses with the revenues they help generate in the same period. Helps you get an accurate picture of profit for that period.
That accrual concept you mentioned, yeah, it's a bit different from how we might track our personal cash flow, isn't it?
It really is.
So like if my company does worth, say, $10,000 this month, but the client pays next month.
You still record that $10,000 as revenue this month because you earned it this month. That's accrual. It gives a truer picture of performance than just tracking cash in and out.
Got it. Okay, so building on those principles, let's talk about the engine, the double entry system. You hear this term a lot.
Yes, this is absolutely fundamental. Double entry. It means every single financial transaction affects at least 2 accounts, always. One account gets a debit entry and another gets a credit entry, and the amounts must balance. It's this core balancing mechanism.
A debit and a credit. And there are rules for deciding which is which, the golden rules.
Yes, exactly. These help apply the system correctly. They sound a bit old-fashioned maybe, but they work. For real accounts like assets, it's debit what comes in, credit what goes out. For personal accounts like people you owe or who owe you, debit the receiver, credit the giver. And for nominal accounts, like income and expenses, debit all expenses and losses, credit all incomes and gains. These rules, they aren't just random. They reflect how value moves. Think of debits as where value goes or increases in assets expenses. Credits are where value comes from or increases in liabilities equity revenue.
It sounds complicated, but the underlying idea is balance, right?
Perfect balance. Every debit has an equal corresponding credit. Always.
So the example, buy goods for $5,000 cash. The purchases account gets a debit because goods came in, and the cash account gets a credit because cash went out.
Exactly. $5,000 debit, $5,000 credit. Perfectly balanced. That's the heart of it.
Okay, so you're recording all these transactions, debit here, credit there. How do you, check your work, make sure it all adds up before you create the big reports? That's the trial balance, right? The checkpoint.
That's precisely its role.
Yeah.
A trial balance is essentially just a list of all the accounts in your ledger with their final debit or credit balances shown side by side in 2 columns. You prepare it on a specific date, say the end of the month or year. It's a vital step before you move on to the final accounts.
And what does it actually do for the business? What are its objectives?
Well, first and foremost, it checks the arithmetical accuracy of your bookkeeping. If the total debits in one column don't equal the total credits in the other, you know there's a math error somewhere.
Okay. A basic check.
Very important basic check. Second, it's a huge help in preparing the final accounts, the income statement, and balance sheet. It gathers all the balances you need in one place. Third, it helps find certain kinds of errors. Not all errors, mind you, but things like posting to the wrong account might show up. And finally, it just confirms the books are balanced, that the double entry principle has been followed.
So the bottom line is, if total debits equal total credits on that trial balance,
you can be reasonably confident your math is okay. It doesn't guarantee everything is conceptually right, but the arithmetic checks out. It's a big hurdle cleared.
right. Okay, next up is a distinction that seems really important for how costs are treated. Capital versus revenue expenditure.
Oh, absolutely critical. Getting this right is fundamental to presenting a fair view of the company's financial health. It affects both the balance sheet and the profit and loss statement.
So if you misclassify something here,
You could seriously distort the company's reported profit or its asset base. It's important.
Okay, so break it down for us. Capital versus revenue. What's the difference?
Okay, capital expenditure. Think long-term benefit. It's usually a significant one-off cost for something that will help the business generate revenue for, well, more than 1 year. Because it provides future benefits, you record it as an asset on the balance sheet. The classic example is buying a big machine or a building.
Got it. An investment in the future, essentially.
Exactly. Now, revenue expenditure. Think short-term benefit. These are the regular day-to-day running costs, things that maintain the business or are used up within the current year. These costs are matched against the revenue of the current period, so they go straight to the profit and loss account as an expense, like paying salaries, buying stationery, or minor repairs to that machine we mentioned.
So buying the machine is capital,
Yes.
but paying for its annual service is revenue.
Perfect. That's the distinction. Does it create a long-lasting asset, capital, or is it just keeping things running day-to-day revenue?
That's a helpful way to think about it. Creates an asset versus maintenance.
It's a good rule of thumb.
All right. Now, connected to those long-term assets, those capital expenditures, there's this thing called depreciation. How does that work?
Right. So you've bought this asset, this machine, let's say. It's on your balance sheet. But it won't last forever, will it?
No, it'll wear out or become obsolete.
Exactly. Depreciation is the accounting way of recognizing that loss in value over time. It's about systematically allocating the cost of that asset as an expense over its estimated useful life. It's not necessarily tracking the market value, but rather spreading the costs of using up that asset against the revenues it helps generate each year as part of that matching concept we talked about.
Okay, so it's an expense, even though no cash is necessarily going out each year for depreciation itself.
Correct. It's a non-cash expense, but it affects reported profit. And there are different ways to calculate how much to expense each year.
Methods of depreciation.
Yes. 2 common ones are. First, the straight line method, or SLM. This one's simple. You spread the cost evenly over the asset's life. The formula is basically cost minus estimated scrap value at the end, divided by the estimated useful life in years. You get the same depreciation expense every single year.
Okay, predictable.
Very. The second is the written down value method, or WDV. This one's a bit different. You calculate depreciation in a percentage of the asset's remaining book value each year. So the depreciation charge is higher in the early years and gets smaller over time, reflecting the idea that maybe an asset is more efficient or productive when it's newer.
So using that straight line method example, machine costs $10,000. You think you can sell it for $1,000 scrap at the end of, say, 3 years.
Right.
So the amount to depreciate is $9,000, $10,000 over 3 years.
That's $3,000 depreciation expense each year. Straightforward.
Makes sense. Okay, let's clarify the flow of information. We mentioned recording transactions. Where do they get recorded first and how does it get organized? Journal versus ledger.
Good distinction to make. It's about the journey of the data. The journal comes first. It's often called the book of original entry. Every single transaction, as it happens, gets recorded here first, in chronological order, date order. With details, debits, credits, maybe a short description. Think of it as the diary of the business's financial life. Raw data capture.
Okay, the diary, chronological. What about the ledger then?
The ledger is where things get organized.
Yeah.
All those transactions from the journal. They get posted or transferred to their respective accounts in the ledger. The ledger contains a separate page or section for every single account. Cash, sales, rent expense, machinery, everything. So all the debits and credits affecting cash, for instance, are collected together in the cash account in the ledger.
Ah, so the journal is the timeline, and the ledger is like the set of folders, organizing everything by category.
That's a great analogy, yeah.
Yeah.
The ledger groups all the effects on each specific account. And it's the balances from these ledger accounts that you use to create the trial balance we discussed earlier, and then the final reports.
Journal first, raw data, timeline, then ledger, organized data by account. Got it.
Got it.
Which brings us nicely to the end goal, really, the culmination of all this recording and organizing. The final accounts, the report card.
Exactly. The final accounts are the primary way a business communicates its financial performance and position to the outside world and to its internal managers, too. They summarize everything for a specific period, usually a year.
And what key statements make up these final accounts?
Typically, there are 3 core statements. 1, the trading account. This one focuses purely on the buying and selling activities. It calculates the gross profit, basically, sales revenue minus the direct cost of goods sold. It shows the profitability of your core trading operations.
Okay, gross profit before overheads and stuff.
Right. Then comes number 2, the profit and loss account, or income statement. This takes the gross profit from the trading account and then deducts all the other operating expenses, rent, salaries, utilities, depreciation, etc., and adds any other income. The result is the net profit or loss for the period, the famous bottom line.
The bottom line. Okay.
Yeah.
And the third one.
The balance sheet. This one's different. It's not about a period of time, it's a snapshot. It shows the company's financial position on a specific day, usually the last day of the accounting period. It lists the company's assets, what it owns, its liabilities, what it owes, and its capital or equity, the owner's stake. And it always follows that fundamental accounting equation. Assets, liabilities plus capital. It must balance.
Assets equal liabilities plus capital. That's the bedrock.
It is. Understanding those 3, trading account, leading to gross profit, profit and loss account, leading to net profit, and the balance sheet, showing financial position, that's really key to reading a company's financial story.
Wow. Okay. We've covered a lot of ground there. From the basic idea of accounting as a language, through double entry, all the way to these final reports, we took those core concepts and hopefully made them a bit clearer. You should now have a much better feel for what accounting is trying to achieve. Those key rules like debits and credits, how costs are handled, and how assets, well, how their cost is spread over time.
And thinking bigger picture, grasping these fundamentals really does empower you. Suddenly, financial news makes more sense. You can look at a company report with a bit more understanding, maybe even manage your own finances with some of these principles in mind.